Bearish institutional reference point or premium array. The bearish rejection block. The bearish rejection block is an ICT tool I've borrowed and made my own. And what it is this: is you can use price action and candlesticks to depict this on a chart and trade it. So price trades upwards. So price is rallying into a premium. So this is rallying into a premium, and it rallies into a bearish institutional reference point. It rallies into an area where we believe there should be resistance, and we see a strong reaction. So when price reaches that level that we believe should have a strong resistance delineated by this red line, we see a strong reaction. Do you see the white candle that touches this red line? Do you see how high the wick goes up? And then see where the candle closes. Do you see the distance, the big gap between the higher of that wick and the close and where the candle ends up closing? So that is what we're talking about. So price trades into a resistance level and a strong reaction creates a long wick. Now, confirmation for the bearish institutional confirmation for the rejection block. The following down close candle trades into the candle's wick, but fails to go beyond that high and closes lower instead. Now, this is the principle for the rejection block. The next candle after we traded into that institutional reference point, that resistance level, you want to see the next candle trade into that long wick that was created, but it should not go beyond the high. It should trade into that long wick and then strong rejection downwards, as we see in this big down close candle, and then that move from trading into this long wick, we see selling pressure so strong that we see a down close candle, a big down close candle, followed by another down close candle, followed by a third down close candle. The idea is this: sellers capitalized on price when it was delivered to this high, and there were sell orders that were unmitigated, resting here in this wick. So sell orders that didn't get executed, resting here in this wick. So price trades back into this wick, and those sell orders get executed, and we see price now move in the direction that it intends to go, downwards. So entry technique, how I trade this rejection block, I sell the close of the confirmation candle. So when I see that this candle, the one that succeeded the candle that had a long wick, after it has closed, so we traded into the wick of that candle, there was a strong rejection away from that wick, and then price closed lower. I want to sell the close of that candle with my stop above the high. My concept is that this rejection block, we've already mitigated the sell orders that were in that long wick. Price ought not to go any higher if intention for the move is truly bearish. Okay, ladies and gentlemen, so in this section I want to introduce you to the bearish institutional reference point, the bearish premium array, which is known as the rejection block. So the rejection block on the bearish side is going to look like an up close candle trading into a suspected resistance area. Now, when this up close candle trades into this resistance area, it rejects off of that area, forming a long wick. How this candle is confirmed is that you want to see price trade into the wick of that candle, but fail to trade beyond the wick of it. And after trading into the wick, you want to see price get rejected away from that. So if we're bullish and say this is the high we're going to consider, all right, this is the high we're going to consider. So say that this area, this box I just, this red box was a suspected resistance area, right? I told you that sellers sell the high, so we had external liquidity in the form of what? Buy stops resting up here. So price reached into these buy stops, and you see that the up close candle that traded into that buy stop forms a long wick, right? So it rejects of that area and forms a long wick at the same time. And then the next candle that precedes it trades into that wick of the candle, but cannot trade beyond it. Instead, it trades lower, and the next candle trades lower. Ultimately, price rejects away from that candle. So how do you trade a rejection block? Well, you know that you're expecting price to react off of a resistance area. When you see that long wick trade and appear like we saw here, you expect it to be the rejection block. So the rejection block is confirmed on the next trade when the next candle opens and it trades within the wick of the previous candle but fails to trade beyond it. So once that candle closes and we confirm that it's an order block, you can look to sell the close of the candle. So imagine this down close candle right here, right? If we sold the close of this candle, this would have been our entry point, okay? So our entry point on this candle would have been 294.36. Right there. And our risk will be where? Above the rejection block. Alright? So you sell at the close of this down close candle with your stop above this rejection block wick, and look at the candle's trade. Look at the trade from this candle. Ginormous trade, right? So this is a rejection block setup. The bearish institutional reference point, premium array. The bearish common order block. Now the common order block is also an ICT tool. I've borrowed and made mine. And here we have the bearish institutional reference point, which is a suspected resistance level. We believe that there should be sellers at this resistance level. Now, a common order block is the highest up close candle with the most range between its open and close near a resistance. So when price was rallying upwards and we got close to this resistance, when we touched it, it was still an up close candle, right? That was the highest up close candle prior to mitigating that resistance level. Now, this common order block is confirmed when the next candle that forms trades through the low of the highest up close candle. So after this up close candle touches this resistance level, we want to see strong selling pressure. Strong selling pressure enough to take out the low of this last up close candle. When that low is taken out, we can confirm this to be a bearish common order block. And the entry technique for trading the common order block is when price trades lower than the bearish order block, then returns to the order block candle or the candle's low. This is bearish. Your stop is the high of the order block candle. So remember I told you the order block is the up close candle near the resistance, where most range. This white up close. When this down close formed, succeeding it and traded lower. If price returns back to this up close candle's low or close, or the mean threshold, which is the 50% of that order block, then you want to sell the market with your stop above the high. So this is what it would look like, right? So we have an order block formed in the market, the highest up close candle prior to touching a resistance level. And then we see it confirmed because the next candle that forms is a down close candle, and that down close candle trades below the low of the previous candle. Now what happens next? You see the candle now, the second down close candle, traded all the way into the body of the common order block. And when it traded into the body of the common order block, we saw selling pressure send price lower, and then price continued lower on the next candle. So when that order block forms and price trades back into it, you want to sell stop above the high. Hello ladies and gentlemen, in this video I want to explain the bearish institutional reference point, the premium array called the common order block. So this is a bearish order block. So now you know that we have a suspected premium area, a suspected resistance area that price is trading to, right? So price trades into the suspected premium area. So we see this up close candle right here, the last up close candle before trading into this pink box. Now watch the price action after price trades into this pink box. We see a down close candle that trades below the low of the previous candle. So remember we said in the presentation that an order block, a bearish order block, is the last or the highest up close candle that trades into its resistance area before being confirmed by a down close candle that trades below the low. So here in this scenario, we see that the down close candle trades below the low of this previous up close candle right here. So that is confirmed. So what you can do now is you can sell the close of this order block, or you can sell price retracement into the order block. So what that means is you can sell the down close, the close of this down close candle. So this down close candle closed at 440.13. You can afford to sell that level, which is opening a sell. You can sell with a stop order just slightly below that close, right? And your risk is going to be at the top of the order block. And then the other entry you can have is you can decide to wait for price to return to the order block, and here price returns to this order block low, the low of 457.51, and you can sell that. Let's take a look at the bearish breaker block. The bearish breaker block is a bearish institutional reference point. It's a premium array. It is bearish, so this is where sellers will look to capitalize on price and open short positions. And let's dive deeper. So the bearish breaker block is a range or down close candle in the most recent swing low before an old high is violated. It is a range or a down close candle in the most recent swing low before an old high is violated. The buyers will seek to mitigate the loss when price returns to the old swing low. This is bearish. This is what it looks like. So here we have a bearish institutional reference point. We have a level where we suspected price to see or encounter resistance. So price was initially rallying up and impulsing upwards. Price reacted off that level. Sellers showed a willingness to push prices lower. And this right here is a breaker block. So this low right here, where my mouse is pointing at, that would represent the down close candle in the most recent swing. That would represent a down close candle in the most recent swing low that led to this high being violated when price took out this high here. And how do you trade this breaker block? Well, after this low is violated in a latter move down, price will eventually want to reach for this low. Why? Well, there were institutional buyers who bought this low and sent price up. They thought that price was going to keep going up. Price failed, and now price is now below their entry point, so they are losing money. If price can return back to this low, their entry point, that gives them an opportunity to close their initial. That would give them an opportunity to close their initial long position for net zero, essentially not losing any money. So that's what they want to do. And when they close that long position, what do you think that's going to do? Remember, when you close a long position, how do you close? You sell to close. That's just injecting more sell orders into the market. So that will push price even lower. So an entry technique, how do I trade this? How do you trade the bearish breaker block? Well, for a beginner, I would advise you to trade the bearish breaker block after this low has been violated. So when this low is violated and price returns back to that low, then you should look to enter and sell the market short. But for professionals, when the market formed this high and made this swing low at this resistance level, you would suspect that there was a probability for price to run this high. Why? We've talked about order pairing. Sellers who sold this high have protective stops sitting above this high. Sellers who sold this high intending to make money on this downswing have protective buy stops resting above this high. What do you pair with buy stops? You pair sell orders with buy stops. So institutions that want to sell at large quantities, where they're going to pair their sell orders with, they're going to pair with the buy stops that were resting above this high. So the market maker knows that there are orders here and has a lot of sellers that he wants to satisfy their desires. What is he going to do? He sends price all the way above this high to be filled with the buy stops. Once those buy stops were filled, what happened? You see it down swing. So professionals will sell this high. So this is where you get in. So when this move goes, this is the breaker block. You have this impulsive move, reaction of this resistance, forming this low. Rally again and takes out this high, and then a further decline that takes out this low. See here? So when price returns to this low, this level, delineated by this chopped blue line, that's where you should look to sell and take the market lower. And I want to introduce you to the bearish institutional reference point and the premium array called the breaker block. So price action on the breaker block is going to do like this. So price rallies into a suspected bearish area and then declines, showing willingness for sellers to sell the market. Now, price will make another advance to run out the high of that previous swing before a market shift to the downside. This confirms the breaker block. So your entry is going to be when price returns to this low right here. Buyers who are now under the water are going to mitigate their losses and close their long positions for break even. Maybe even enter shorts into the market, ultimately sending prices lower. So now let's take a look at this price chart, right? And on this weekly time frame, we see that price has been making a bunch of impulse swings. And most recently, we see an impulse swing form, making this high here. And then a retracement. And then price rallies just above the previous high made, and then declines. So if I'm seeing correctly, this high formed here is lower or lesser than the newer high formed here before this market structure shift to the downside, just like this pattern to your right. Alright, so that confirms the breaker block. Now your entry on the breaker block should be, you consider the range which is formed by the lowest candle in that swing low. So when price made this contraction to the downside, the candle that formed the low or the lowest point in that contraction, which is this up close candle, that is going to be the range you want to consider. So when price returns to this range, you want to sell the market. So you can map out the range with this rectangular box, mapping out the high and the low of that candle. And when you pull price, listen, do you see how when price broke below this low right here, it rallied back up? And when price rallied back up, where did it touch? It just traded, the wick of this candle just trades into that range. And once the wick of the candle trades into that range, what happens? Boom. Vicious decline. That is the breaker block, ladies and gentlemen. Let's take a look at the bearish failure swing. Bearish failure swing is a bearish institutional reference point. It's a premium array. So sellers will look to capitalize and open short positions off of bearish failure swing setups. So this is what the bearish failure swing looks like. Price. So it's a bearish down close candle in the most recent swing low. below a failed attempt by price to violate an old high. It is the down close candle in the most recent swing low before a failed attempt by price to violate an old high. So you see in this diagram, you see a bearish institutional reference point. You see a level or delineated by a red line where we expect resistance in the market. Price declines sharply away from that red line. That's sellers coming into the market, showing that there's a willingness to send prices lower and respect that premium array. Now buyers find support here, make this low, and try to buy up this market again, intending to send prices higher, but they fail. Do you see that this second swing upwards fails to go beyond the previous high? This is what we talked about in definition. It is the most recent swing low before a failed attempt by price to violate an old high. So that is what we have. That's what happens here. So this is where we're going to have a bearish failure swing. This low right here, if you pay attention to my mouse that is moving right now, this failure swing right here is where we're going to have short positions. If the market breaks this low and then returns back to it, institutional buyers who thought the market would go up and are now losing money because the market has declined beyond their entry point will look to close their positions for net zero, essentially not losing any money if prices can return back to this low. So entry technique, you want to sell upon price retracement to a newly violated low. So this low that was violated, when price returns back to it, you want to sell that. You want to sell that move. And this is what it should look like. So you have the bearish institutional reference point, you have the red line delineating that price impulse swing up to that red line, declines, another impulse swing, fails to take out the previous high, and then a further decline. So this low right here became our failure swing. So when price returned back to that low in the future, which is right here, what happened? You open a sell position, and what happens to the market? And the market falls. Welcome back, children of God. So in this example, I want to introduce you to the concept of the bearish institutional reference point, also known as aka the premium array, which is the failure swing. So we want to take a look at the failure swing, also known as the mitigation block from the bearish side. So on a bearish setup, here you know that the price pattern for a mitigation block or a bearish swing should look like price trading into a suspected premium array, and then you see so you already know that what the price pattern for price action on a mitigation block will look like will be an impulse move into a suspected resistance area. Then you should see sellers coming to the market showing willingness to sell the market. Then you see an attempt to buy up the market for a continuation, but that fails and price can not make a higher high, instead break structure and shift to a bearish market on the downside. So you know how to trade this will be a retracement back to this same low, because buyers who bought this low are now losing money as prices below their entry. So when price returns back to that low, they will close their buy positions and inject more sell orders into the market, sending price lower. All right, so let's look at the market right here. What do we see here? We see an up price that is moving an upwards movement, then retraces downwards, tries to expand but cannot go beyond its previous high, then retraces downward. Same thing or a different thing? Are these two things the same patterns? Alright, so now how you want to trade this is that you want to look at the lowest candle that formed on this swing low. So the lowest candle that formed in this area is what we're going to look at. And that is this down close here. So consider the range of this candle, right? Consider the range of this candle. Or in this scenario, we want to take these two candles, which are pretty much combined together to give a range. And we want to look at the range of these two candles, which form the low of that swing in the mitigation block, right? And look at, so when price traded below this low, it retraced back into that area, back into to mitigate the losses of the initial buyers, who now get the chance to close their buy positions for break even and enter sells, and then the market declines further. bearish fair value gaps, bearish institutional reference points, and premium arrays. Okay, so this is what a fair value gap looks like. It is a range in price delivery where one side of the market liquidity is offered and is confirmed by a liquidity void on the shorter time frame in that same price range. So it is a range in price delivery. It is a range in price delivery where one side of the market's liquidity is offered. Do you see how? Let's pay attention to this diagram. Look at the first down close candle. This is blue candle that opens here. Look at the size of the body. And then look at the size of the next candle's body. Now pay attention to the white up close candle, the last candle, and look at the size of its body. Do you see that the candle in the middle is significantly larger in terms of length? Or should I say, length, than the first and the last candle? So there was a big displacement in price downwards. And in that displacement, there was a lot of selling volume, a lot of sell orders hit the market. So the low of the previous candle and the high of the third candle, that forms the fair value gap. And the fair value gap is specific to whatever time frame you observe the chart. So if you observe the chart on a 1 hour time frame and you see a fair value gap, you treat it as a 1 hour time frame fair value gap, and you trade it as a 1 hour time frame fair value gap. If you see the fair value gap on the weekly time frame, you treat it as a weekly time frame fair value gap, and you trade it as a weekly time frame fair value gap. So when you look at this diagram, the first candle, look at the low of the first candle, right? And look at the high of the last candle. And look at the high of the last candle. Do you see that there's a gap in between the low of the first candle and the high of this last candle, where it is just sell orders coming into the market? It is just sell orders. No counter orders, no buyers. It creates a void, an imbalance in the market of just sell orders. That's what we call a fair value gap. So if price revisits this area, institutions will see it as a fair price to purchase or sell the asset depending on the trend, given that there was an imbalance in the market and only one side of liquidity was delivered. So entry technique, when price trades back into that fair value gap, then you want to sell. You sell and you place your stop above the fair value gap. So this is what it's going to look like. So this is the fair value gap we had. This was a diagram with the first candle. We had a big displacement. We had a third candle, which was a white big body as well. And then we had a gap in between, which was the fair value gap. So now you see the next candle that appeared happens to be an up close candle again. The up close candle traded into the 50% level, halfway of the fair value gap. And what happens next? D said that the candle that forms after it is a down close candle that totally just drops and declines. That was a reaction away from the fair value gap. So what happened was that price trading into the fair value gap was able to fill all the remaining sell orders up onto that price level that had not been filled when that imbalance was created. And upon filling those orders, price could now decline further. Why? Because institutions are greedy. They are selling right now. They want to keep selling. The lower the prices get, the more money they make. I want to introduce you to the bearish institutional reference point, the premium array called the fair value gap. So the fair value gap will be an imbalance created in price delivery where only one side of the market is delivered. So in a bearish situation, a fair value gap means that only sell orders are delivered within that gap. All right. So to export the fair value gap, you want to see an imbalance which is usually identified by a large body candle, when the range or the candles around it are relatively smaller than another body's candle or that candle's body. So then you look at the previous candle and look at the previous candle's low right here, and look at the next candle and the next candle's high right here. So you see that there's a gap created between the high of this candle and the previous candle's low. There's a gap created, so you expect that price should trade into this fair value gap, and when price trades into this fair value gap and price fills the sell orders that are there, price will be allowed to trade lower into discounted prices. So how do you trade this? Your goal is to execute when price trades into the fair value gap with your stop just above it. So let's go ahead and you can see that candles just trade into the fair value gap now. You can go ahead and buy. So you can go ahead and sell because we're looking at a bearish sell, a bearish fair value gap. So you can sell that fair value gap and with your stop loss just above the fair value gap. So in this scenario, we're risking $1,500. So because we're risking $1,500, we can afford to increase our position size by 2 more contracts. Sorry, I meant to sell. Alright, so now we can take 12. And you know that they're going to be buy stops. Sorry, they're going to be sell stops below the lows. So you can look to take profit at a below this low here. So this is a 2-to-1 risk. This is more than just slightly above a 2-to-1 risk to reward trade. Alright, and let's see how the market is going to trade. And the market feels straight ahead. And let's see, price continues lower. Price continues to drop lower violently, as a matter of fact. Alright, so that's the fair value gap. Ladies and gentlemen, welcome to this A-Star Investor Mentorship. On this episode, we'll talk about the bearish institutional reference point and premium array we call the liquidity void. So liquidity void is when the market delivers liquidity on one side of the market and it creates an imbalance. So a lot of the time when the market is nearing the end of its trend, you will see a liquidity void form, where the market kind of like just wind tunnels downwards in the situation when the market is trending downwards. And in the situation when the market is trending upwards, we kind of like see the market just wind fall upwards or wind, fly upwards. So in this situation, you can see how we've been having series of down close candles. We had a breaker block here that formed with this contraction, then an expansion, then contraction that takes out the high of this previous candle, then a lower, another leg down. So if you analyze this lower leg down, you see that it's majorly made up of down close candles, another down close, then we have 2 up close candles, then 2 big body down close candles, and then a smaller down close, 1 up close candle, then about 6 or 7 big body down close candles relatively. Alright, so this creates a liquidity void. Do you see this? Up until this point, the market was just delivered on the downside, only sell orders. This created a liquidity void, this imbalance. And how do you trade this? You know that liquidity voids want to get filled. So when the market bottoms out here, you expect that liquidity void is going to get filled. So you can take buy orders, buying these lows and selling the high of the swing, or selling these impulse swings. Sorry, selling these contractions highs that were made in the move, like the high above this up close, the high above this up close.